Inflation and its impact. Hi, my name is Anuj Gupta. I'm an entrepreneur, mentor, and advisor, founder of Tag Investments, a wealth management and taxation services firm having over 10 years of financial domain experience. We are licensed and registered with IRDA, Insurance Regulatory Development Authority, SEBI, Securities Exchange Board of India, and MCA, Ministry of Corporate Affairs. Well, let us try and understand as to how inflation impacts our savings and investments, thereby impacting our financial goals. For example, we've taken various asset classes, fixed deposits, bonds, and equities, and comparing it over a period of 15 years. Fixed deposits, say, over a period of 15 years, give us a return of 7% annually. Bonds, they give us a return of 10%, and mutual funds, equity based, give us a return of 15%. So, we talk about the real returns as to what are the real returns. So, the real return definition is the return which you get from that asset class minus the inflation minus the taxation. So, we need to understand the taxation rules of various asset classes. The fixed deposits taxation is taxed as per the income tax bracket of an individual. Similarly for bonds, and for equity it is 10% in the long term capital gain, because we're talking about 15 years here. So first 1 lakh is tax exempt, and beyond 1 lakh of capital gain is taxed at the rate of 10%. For the sake of example and simplification, we'll assume it at 10%. So in FD, if we talk about the real return, it is 7% minus taxation on the interest and minus inflation. So the inflation rate here assumed is 7% for calculation's sake. So the real return in FD would be 7% minus, I'm assuming who is in the top tax bracket, which is 30%. So 30% of 7%, which is 2.1, minus 7%, which is inflation rate. So 7 minus 2.1 minus 7 is equal to minus 2.1% is the real return, which is in negative. In bonds, 10%, again, we are assuming that somebody who is investing in bonds is in the highest tax bracket. So 10% minus 30% on 10% minus 7. So 10 minus 3 minus 7. So his real return would be 0%. In equity, 15% minus 10% of 15, which is 1.5, minus 7, which is inflation rate. The taxation rate in equity is 10%. So 15 minus 1.5 minus 7 is equal to 6.5. Thereby clearly showcasing that equity based investments, or as an asset class, equity stands out to be the best asset class in terms of returns in the long term. Now the next question would be, how long should we be investing? The answer is simple. It should be simply based upon your financial goals and the timelines attached to your financial goals. If you have a short term financial goal, then you can invest in FDs. If you have a mid term financial goals, you can invest in a product which gives you a 10% return like bonds. And if you have a long term financial goal like your own retirement, your children's education, which is like 5, 10, 15 years time is left, then you can invest in equity based mutual funds. Thereby clearly showcasing that if you want to beat inflation, then you need to stay invested in an asset class which gives you more than at least 10% returns, which as of today, the best investment asset class would be equity. And how you can take exposure in equity is through the mutual fund route. Thank you so much for the watch. I'm sure you would have further questions, queries, concerns basis on how can we beat inflation and how can we get better returns and inflation adjusted returns. So you can comment on the link below, or you can just log on to our website, social media channels. You can drop in your name, number, email ID, and we promise you to revert back and solve your queries. Thank you so much.